In past banking crises, collapse did not arrive without warning. It emerged from familiar pressures that accumulated quietly, often dismissed as temporary or manageable. What makes the current situation different is not scale alone, but alignment. Commercial real estate debt is approaching a refinancing wall. Bank balance sheets are carrying losses that exist but are not yet acknowledged. Derivative exposure remains deeply intertwined with interest rates and asset values. These forces are no longer isolated. They are converging. This is not a sudden shock event. It is a system already under strain, moving toward a point where choices narrow and reactions replace control. The question is not whether stress exists. It is how long the system can absorb it. The foundation of the current banking stress begins with commercial real estate, a sector that expanded aggressively during an era of near-zero interest rates. For years, office buildings, retail centers, and mixed-use developments were financed under assumptions that no longer hold. Occupancy was expected to remain stable. Refinancing was assumed to be cheap. Asset values were treated as durable. Those assumptions shaped trillions of dollars in lending decisions. Between now and the middle of the decade, a large volume of these loans reaches maturity. The timing matters. These debts were structured when borrowing costs were minimal and property valuations reflected peak conditions. Today, interest rates are significantly higher, while demand for office and retail space has structurally weakened. Remote work reduced office utilization. Digital commerce hollowed out physical retail. The cash flows that once supported these loans have deteriorated. When refinancing becomes necessary, property owners face an arithmetic problem rather than a market sentiment issue. Higher rates increase debt service. Lower valuations reduce collateral coverage. In many cases, both pressures apply simultaneously. The result is not gradual adjustment, but binary outcomes. Either new capital is injected, or defaults begin to cascade. Large national banks anticipated this shift and reduced exposure early. Regional and local banks did not. Their balance sheets remain heavily concentrated in commercial real estate loans tied to specific cities and sectors. As refinancing approaches, these institutions are exposed to losses that cannot be diversified away. The risk is not theoretical. It is embedded in loan structures already written, waiting for maturity dates to arrive. Commercial real estate stress alone would be manageable if bank balance sheets were otherwise resilient. They are not. A second pressure has been building quietly through accounting treatment rather than credit decisions. During the period of extremely low interest rates, banks accumulated large portfolios of government bonds and mortgage-backed securities. At the time, these assets were considered conservative. They offered safety, liquidity, and regulatory comfort. The vulnerability appeared when interest rates reversed. Bond prices move inversely to yields. As rates rose, the market value of these securities fell sharply. The losses were immediate in economic terms, but delayed in reporting terms. Accounting rules allow banks to avoid recognizing these losses as long as the assets are not sold. On paper, capital ratios appeared stable. In reality, a significant portion of bank equity had already been eroded. These unrealized losses are not evenly distributed. They are concentrated in the same regional banks that carry heavy commercial real estate exposure. The combination matters. Losses on securities reduce flexibility. Losses on loans reduce solvency. Together, they compress the margin for error. A bank facing deposit withdrawals may be forced to sell assets at depressed prices, instantly converting unrealized losses into realized ones. Recent history offered a preview. When depositors questioned balance sheet strength, withdrawals accelerated rapidly. Liquidity evaporated before regulatory solutions could be deployed. The lesson was not that bonds are unsafe or that banks are mismanaged. The lesson was that confidence operates on perception, not accounting categories. Once doubts form, timing becomes decisive. In that environment, hidden losses are indistinguishable from actual insolvency. The third pressure emerges from a layer of the financial system that remains largely invisible during stable periods. Derivatives do not appear on balance sheets in the same way as loans or securities, yet their scale and interconnectedness amplify stress when underlying assumptions fail. Over decades, derivatives evolved as tools for hedging interest rates, currencies, and credit exposure. In practice, they also became a dense web of counterparty obligations linking banks, funds, and institutions across the system. The size of this market far exceeds the underlying economy it references. Most contracts offset one another during normal condition, time 0.3s, creating the illusion of balance. That illusion depends on continuity. It assumes that counterparties can perform, that collateral remains sufficient, and that markets remain liquid enough to adjust positions. When those assumptions weaken, derivatives transmit stress faster than traditional lending channels. Many of these contracts are tied directly to interest rates and asset valuations. Those same variables are already under pressure from refinancing risk and unrealized losses. As volatility rises, margin requirements increase. Institutions must post additional collateral precisely when their balance sheets are least able to absorb it. Failure to meet those calls does not remain isolated. Obligations shift outward, forcing losses onto counterparties that may already be strained. This is how localized problems become systemic, not through a single default, but through sequences of obligations that activate simultaneously. Each institution acts to protect itself, yet collectively the system tightens. Liquidity is hoarded. Trust contracts. What begins as a balance sheet issue evolves into a coordination problem. At that stage, outcomes are driven less by asset quality and more by timing, leverage, and interdependence. When pressures converge at this scale, regulatory frameworks become a critical variable. After previous crises, safeguards were introduced to limit leverage, improve transparency, and reduce contagion risk. Over time, many of those constraints softened. Compliance thresholds were adjusted. Exemptions expanded. Oversight increasingly focused on the largest institutions, while regional banks operated under lighter requirements despite carrying concentrated risks. This asymmetry matters. Smaller banks play a central role in commercial real estate lending and local credit creation, yet they lack the buffers and access to capital markets available to national institutions. When stress emerges, their options narrow quickly. They cannot easily raise equity. They cannot absorb prolonged losses. Their stability depends heavily on depositor confidence. Signals from regulators suggest awareness rather than prevention. Deposit insurance funds have been reinforced. Emergency lending facilities have been extended or reactivated. These measures are designed to manage failures, not eliminate them. They function as containment tools once confidence weakens. The presence of such mechanisms does not indicate stability. It indicates preparation. At the same time, insider behavior offers indirect insight. Executives and informed participants reduce exposure when uncertainty rises. This does not require conspiracy or foresight, only proximity to internal data. When actions diverge from public assurances, the discrepancy becomes meaningful. Systems rarely fail without internal recognition. They fail when recognition arrives too late for coordinated adjustment. In this environment, policy choices compress into narrow corridors. Authorities face trade-offs between disorderly failure and inflationary support. Each response carries costs. None restores prior conditions. What remains is management of outcomes rather than prevention of stress. As stress propagates through institutions, the response shifts from balance sheet management to policy intervention. At that stage, authorities are no longer addressing isolated weaknesses. They are attempting to stabilize confidence across the system. The tools available are familiar. Emergency liquidity facilities provide short-term funding against impaired assets. Deposit guarantees are reinforced to slow withdrawals. Mergers are encouraged to absorb failing institutions into stronger ones. Each measure signals strain rather than resolution. Liquidity programs substitute time for solvency. Guarantees delay panic but expand public exposure. Consolidation concentrates risk even as it reduces the number of visible failures. None of these actions reverse the underlying pressures created by refinancing risk, unrealized losses, and derivative obligations. They redistribute them. The central tension lies in the choice between failure and dilution. Allowing widespread bank failures risks systemic collapse. Preventing them often requires monetary expansion. When central banks purchase assets at values above market prices or extend credit against weakened collateral, losses do not disappear. They are transferred. The cost is absorbed through currency dilution rather than explicit defaults. Historicals. Time 0.3s. This process preserves nominal balances while eroding real purchasing power. Deposits remain accessible. Account values remain intact. Yet the goods and services those balances command diminish over time. the visible crisis appears contained. The less visible adjustment unfolds through prices. This pattern is not unique to any one country or period. It reflects a recurring response to financial stress in highly leveraged systems. Once intervention begins, outcomes are shaped less by original excesses and more by the structure of the response itself. In this phase, the consequences become unevenly distributed across participants. Institutions with diversified funding, strong capital access, and global reach adjust first. Those dependent on concentrated deposits and local asset markets adjust last. The distinction is not operational competence, but structural position. Systems reward scale and flexibility under stress. Depositor behavior accelerates this divide. Insurance thresholds shape incentives. Smaller accounts remain relatively stable. Larger balances move quickly once uncertainty rises. The speed of modern withdrawals compresses response time from weeks to hours. Liquidity that appears adequate under static assumptions proves insufficient under dynamic conditions. This is not panic in the emotional sense. It is rational behavior within defined rules. Geography also matters. Markets most exposed to declining office utilization and commercial vacancy experience stress first. Loan performance weakens where property cash flows no longer support refinancing. Banks with concentrated exposure in these regions face correlated losses rather than isolated events. Diversification fails when assumptions fail together. At this stage, information itself becomes a catalyst. Public filings, earnings reports, and regulatory disclosures are reinterpreted through a different lens. Data that once seemed routine acquires urgency. Market participants stop asking whether weaknesses exist and begin asking how quickly they can spread. Confidence, once questioned, rarely returns on its own. What follows is not a single collapse, but a sequence. Failures, rescues, consolidations, and policy responses unfold unevenly. The system does not break everywhere at once. It fragments along structural lines already present, revealing which components were resilient and which depended on stability to survive. Beyond the immediate financial mechanics lies a longer adjustment cycle. Once intervention expands, incentives shift. Capital seeks protection rather than productivity. Risk is repriced not according to growth potential, but according to policy proximity. Assets that align with monetary expansion outperform in nominal terms, even as real economic capacity weakens. This is where the visible crisis fades and the structural one deepens. Inflation does not announce itself as a rescue cost. It appears gradually, through higher living expenses and compressed standards of living. The system stabilizes statistically while pressure transfers outward. The adjustment becomes social rather than financial. Historically, this stage defines the legacy of banking crises more than the failures themselves. Institutions survive. Currency remains functional. Yet purchasing power erodes and inequality widens. Those with access to assets and diversification adjust. Those reliant on fixed incomes and local systems absorb the cost. The process is rarely framed as loss. It is described as recovery, normalization, or resilience. In reality, it represents reallocation. The system continues, but on altered terms. What matters is not whether collapse occurs in a dramatic sense, but how the burden of adjustment is distributed over time. At that point, the original causes are no longer debated. Attention shifts to adaptation. The cycle completes not when stability returns, but when a new baseline is accepted.